budget at around 11, it had started and we were in office. So we all just huddled up together really quick. We turned on the news and we were all watching it. I think budget was one of those insights we all were really personally looking forward to. I now would like to invite Mr. Aditya Gupta and we would like to open the questionnaire.
Thank you so much, sir, for such an insightful presentation.
My pleasure.
And I think you have covered most of my questions. And my first question was about the earnings. And I truly believe that when their earnings returns are bound to follow. And when I invest in equity markets and I advise my clients, and just not looking in the short term, but in long term, I look at like 15 to 20% earnings growth in long term for India. And do you think that we can achieve that kind of growth in long term? Short term, you said that there was an earnings cut of about 10%. So for FY25, we have about 5% earnings growth, and next year we can expect about 17%. But in long term, can we achieve 15 to 20% earnings growth? And what are the major drivers or the structural changes that would drive this growth?
Sure. So let me sort of start with or talk about the twin engines of growth. One is manufacturing, and second is consumption. The story in consumption is basically how the spend goes from currently, which is $2.4 trillion, to $4.2 trillion over the next 10 years. So the 2 and 4 interchange places. And as that happens, it creates a CAGR of close to about 20%. And there are segments of consumption which kind of stands to benefit. But in many ways, the consumption habits of India are changing. So if I were to take a poll here, how many of you have not used Zepto or Blinkit or any of these apps over the next year or two? Please raise your hands. Zero. There is a message in this. How many of you had heard about these names 3 years prior to this? That's again zero. So this is the perfect example of the changing consumption habit of India, particularly when we are talking about urban consumption. Okay? So this is the most glaring example where, overall, while earlier we used to go to the local retail store, shop around and whatnot, now almost like Aladdin and the gin, you rub it off and you say that this is what I want. Before you reach home, the product is there. So that's one glaring example of consumption habit change. Second, I would say is that usually all of you must be well traveled. You would know that one of the things that we think about in India is US में हुआ India में 6 महीने बाद हुआ, बराबर? That's all we think about. You would be surprised to know that the quick commerce hasn't happened in US. It hasn't happened in developed markets. It's happening in India, to a certain extent in China, right? So in many ways, we are now leapfrogging in the way of our thinking ahead of examples which are there in the Western world. This UPI example that I think he quoted. UPI is not present in any of the developed markets. It is very difficult to survive now in the US because everywhere you need hard cash, whereas we have kind of got into a habit of not having cash. So these are two examples, glaring examples. And third, which I would talk about is, I'm sure you follow sort of earnings. Hindustan Unilever in the last quarter earnings call reported volume growth of, anybody? 0%. Indian Hotels reported revenue growth of 30%. Same consumer, no dal chawal, but hotels, anybody who has contemplated going to Mahakumbh would know 40,000 and above. Your bhakti really gets tested. But the point is, it's the same consumer. It's not that people are not spending on dal chawal. But that spend is constant, hence the volume growth of zero. But because the spend is, earnings are going up, your salaries are going up, now you are going to, or an average Indian is kind of going to hotels, going to QSR more than what was earlier, which is the reason behind the growth. So these are the three examples of where consumption is changing. Manufacturing, I've not done it. Wait. Manufacturing. If you ever go to north of India and you look at the road infrastructure that is being created, do you know that if I simply connect a place like Ulve from Mumbai, like the Atal Setu, right, by one road, the GDP of that small Ulve goes up 9 times. This is academically proven example. So just by improving the infrastructure and the road infrastructure of India, connecting the different parts, that itself has a meaningful 8 to 9 times multiplier. So hopefully with infrastructure and consumption with examples, these are the changes which are happening in India right now. This is what happened in the United States round about in 90s. And you saw the GDP per capita really ratchet up. And that's the reason why in India, driven by these two factors over the next 10-15 years, you wouldn't be, you will find it difficult to recognize the face of it in 10-15 years. We are just kind of happy to be inhabiting in India at this point in time when these things are changing. हमने कुछ नहीं किया है. So that's the reason I think net earnings growth of 15 to 20% is something which is certainly doable. What we have to be mindful is how do we participate in that growth? And how do we stay away from the legacy areas and make sure we are betting on the right areas so that we can capture that in part of our portfolios. But grow India for sure it will.
And truly we just lead the way in the digital economy and the inclusion. The kind of digital banking, the UPI system that we have created. A lot of billion-dollar startups have been built on this just tech stack. And even when we were just starting, we had a lot of tech stack sorted by our UPI, even our exchanges. So we can build on top of it. So it becomes very easy for us as entrepreneurs to start and build something. So we talked about earnings, and the other factor that on a technical side drives the market returns is liquidity. And there has been a lot of talk about it. FIs, we have seen a tremendous market growth from 2020 till September last year. And then since September, we have seen majority of FI outflows. There has been a lot of talk about it. What do you think? Does this seem a temporary change due to geopolitical events? Or is it a structural change that the ownership of our market is shifting from FIs to DIs?
So I think the behavior is cyclical. The second part is structural. Why I say the behavior is cyclical? Imagine you are a US investor. You earn your return in dollars. Now over the last 6, 9, 12 months, dollar is appreciated somewhere close to mid-single digits or high single digits. So for the return that you make in a country like India in rupees, by the time it gets translated to dollars, it kind of you lose almost somewhere between 5 to 10%. So practically for all practical purposes, the India growth story is eaten up by the currency. Why shouldn't the withdraw? So they are very logical in doing so. But the answer lies in pretty much the question itself. That the moment the dollar stabilizes, you will see FII starting to come back. When the dollar stabilizes, hopefully after the Trump's policies and tariffs and barriers and all that he wants to do, once we are out of the way, the market has digested, I think the dollar will find its equilibrium level. You've got to wait patiently till that for that to happen. So this is the cyclical part of where we are. The structural part is basically finally, I find the Indians are now Hanumans of the generation. Basically, we have a lot of power, we forget our own power. So, finally, actually it was COVID, when everything else was closed, only equity markets were open. Gradually, people have woken up to the power of equities. If you look at number of accounts opened, you've also done well, and many players have seen the benefit coming out of COVID, saying, "Arey wah, ye to liquid hai, aur isme paise bante hain." So, the power of equities is just about starting in India. So there, in terms of the transfer of ownership from FIIs to India, you will actually see this trend accelerate via your Zepto, via your growth, and also, broadly speaking, across India over the next 10 years. And this is just the start of that one.
And sir, my last and final question, there has been a lot of talk of mid and small caps. You manage more than 10,000 crores in your mid and small cap funds. What do you think about the valuations in this space? And are you able to find good opportunities when the mid-cap index is trading at almost 35 times and mid-small cap at about 27, 28 times? Are you able to find good companies at reasonable valuations?
So, in fact, I've just written an article which will get published in Monday in Mint, which talks about that, but here is a preview about this. And be with me for the next 2 or 3 minutes just to explain. So what's happening in markets is we've had 4 years of strong markets. And as a result of this 4 years of strong markets, 2 categories of stocks have done well. One is what I call the beta trade, or the stocks that fit the narrative. They are mid and small. They are those glamorous sectors where everybody is talking about it. Right? But inherently, their business model is weak, right? And I'm sure you understand kind of once you look into details as to what those names are. But some of those went through the roof like crazy over the last 3-4 years. The second category of companies which are genuine business models. For example, since you talk about mid and small cap, do you know that the largest AMC, India's largest AMC is a mid cap? Okay. India's largest engine maker is a mid cap. India's largest listed hotel is a mid cap. And you look at their earnings, their business model is chalk and cheese, absolutely fine. They're growing 20-30%, even in this correction they're off, but kind of 5-10%, which is like gentle correction. So these are the alpha trades. These are those genuine growth stories which will also fall in a sentiment-driven market. But it is this part of the market which one needs to capture in the portfolio. So the market in the current phase, while it re-rated everyone over the last 3-4 years because it was a broad bull market, it is now separating the beta and the alpha. And hence I argue in that article that overall the idea should not be to run away from the markets. The idea is to invest in those strategies which can pick the second category of stocks, or the alphas, the winners of the because, and it's important for you to know why. Because while everything is correcting down, but what will come back are those second category of stocks. What will not come back are the first category of stocks. So if you head with those, which form in the second, the alpha or the growth categories, then when you come back, the money compounding that you will start to generate is significantly larger. And that's how supernormal wealth creation happens. That's how alpha generation happens.
Thank you so much, sir. And now I would invite questions from the audience if you have any questions for sir.
Hate to interrupt this audience, we would please request you to kindly keep your questions to the limited and wrap it up fast. Thank you so much.
Thank you, Mr. Bhattacharya, for explaining the whole gamut of markets and the analogy of markets in 2 slides. You explained beautifully. My question is, with your presentation as well as Ankit's presentation, if India's contribution for global GDP is only 3%, that means the growth story of India is purely based on the domestic growth story. Most of our large companies, whether it is mid-cap or large cap, are catering to the Indian market. So how technically it's basically purely sentiment-driven market where FIS are going out of the market comes down, and there is a huge participation of DI and local participation. Unlike China, where most of the market is for export and all. How you see this Indian market will be behaving in the near future, because we have a lot of indices to catch up in terms of consumption, whether it is FMCG or fuel or energy. Even
It's a great question. Thank you for asking that, and allow me to take 1 or 2 minutes to answer this. It is a boon like any other thing that we are domestic driven, number one. And I've written on this simply because understand what's happening in the globe. Everybody is trying to do a make in their own country version of the economy, right? Make in India, make in US, make in here, make in Pakistan, even if there might be guns or whatever that might be, but make it every individual country is going on, right? So what that means is everybody is trying to go domestic, whereas we are already domestic. The second aspect of this is while China and some of our North Asian neighbors have tried as much as they want to United States, and hence when Trump took over, they have been losing their sleep. We are kind of breathing fine because dekhte hain Trump kya kar rahe hain. You know, they need as much as us as well as we need them. It's a great vantage position to be in there, which is why Modi ji, when he was there, you know, Trump is, all of a sudden Trump's one of the best friends is Modi ji. Why? Not because he loves him. Simply because he needs him. He needs us. He needs the billion consumers that we have here. So it's a boon, like any other thing, at the current moment to be a domestic driven story. Right? Now, look, if you link it with what I said, that we are Hanumans in our own wealth. But if you look at where is our wealth, 95% of our wealth, and you can correct, is kind of, you know, is situated in real estate, gold, basically non-equities. Kahan hai aap log?
About 40% is in fixed deposits.
Very good. So, you yourself have not placed any confidence in Indian entrepreneurs who have been actually surviving despite government regulation for the last century. And finally, over the last 10 years, you have seen India has become the startup economy. So, 10 years regulation has started to become a little helpful. So, and hence I said that as the India's participation in India's growth story increases, our own belief factor in our growth story increases, the domestic part of the story which is there in terms of earnings will start reflecting itself in the holding pattern of the equities. And it will be a great transition to be had. In fact, there is another part of the presentation where I have compared, or I have written an article in this night, where I compared India's growth story with what Japan, Korea, Taiwan went through their own times. And what one finds is that it is a 20-30 year journey, and basically the equities are the main way to play this journey for any country. India is right at the cusp of that from a 5-10 year perspective.
Thank you very much.
Thank you so much. Thank you so much, sir, for this lovely presentation, lovely insights.